Almost all retirement planning frameworks assume two incomes. If you've ever watched a retirement webinar, read a planning book, or watched a YouTube video from a lot of my counterparts, chances are the framework assumed one thing. You're married, 2 social security checks, 2 lives sharing fixed costs, joint tax brackets, and survivor benefits. But what if you're single? Whether you've never married, are divorced, or widowed, the retirement math changes, and most traditional advice doesn't adjust for that reality. Today is the next video we have in our March monthly series for single filers in retirement. We're going to unpack why most retirement advice fails single filers, how spousal benefit assumptions distort projections, how joint tax bracket planning creates bias and the survivor modeling blind spots most advisors overlook, and why single retirees need a fundamentally different withdrawal strategy. Before we dive in, my name is Ryan Knoll, and I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm helping clients nationwide make smart money decisions. Let's get started. There is a hidden assumption in a lot of retirement plans: 2 incomes. Most retirement frameworks are built around married couples because statistically, that's the most common retirement unit. But those models assume 2 Social Security benefits, wider joint tax brackets, shared housing expenses, spousal survivor flexibility, and shared longevity risk. When you're single, none of those assumptions apply. And that's not a small difference. It changes income planning, tax exposure, risk tolerance, and long-term sustainability. Then there's the spousal benefit assumptions, which distort projections. For married couples, Social Security planning includes spousal benefits, survivor benefits, and coordinated claiming strategies. For single filers, there's no secondary benefit. You receive one benefit based on your own earnings record. That means claiming early permanently reduces your only guaranteed income stream. Delaying to 70 often matters more for singles than for couples, and that assumes your cash flow even allows for that. And there's no fallback check if markets underperform. Many retirement calculators model Social Security as a household variable. For singles, it's a single point of failure income source. That makes claiming decisions more critical, not less. And a lot of planning has joint bracket bias. Tax planning advice frequently references staying in a moderate bracket, but those brackets are much wider for married couples. Single filers, on the other hand, face compressed brackets. You reach higher marginal rates sooner. What does that mean in practice? The same Roth conversion strategy that's efficient for a couple is likely too aggressive for a single filer. IRA withdrawals push singles into higher rates faster, and IRMAA Medicare thresholds are lower. Most generalized advice assumes bracket flexibility that singles simply don't have, and that leads to overconversion income spikes or unnecessary Medicare premium increases. Or I've seen it take the opposite effect as well, because some single filers are acutely aware of what makes retirement planning for them more difficult. They're too conservative with their tax mitigation strategies early on. As a result, they're just delaying a tax spike that will more than likely wipe out their early low tax years. Next is survivor modeling blind spots. This one is subtle. Married planning models often include a survivor scenario, but single retirees don't. There's no second income that disappears, but there's also no shared expense cushion. Married retirees benefit from cost sharing: one mortgage, one property tax bill, one insurance policy, and shared utilities. When one spouse passes, expenses don't drop in half. But for singles, you're already carrying 100% of fixed expenses alone. There's no cost-sharing buffer. That means sequence of returns risk hits differently. If markets decline early in retirement, couples can sometimes adjust spending together. Singles often have less flexibility because fixed costs are already concentrated. Most planning frameworks don't account for this difference. Most advisors default to a 4% rule for spending or bucketing your money into short, intermediate, and long-term buckets. But these rules of thumb miss a lot of key pieces. What if you have to withdraw slightly more than 4% because something unexpected happens? Or what if the market corrects? Are you not able to redeploy cash from your short-term bucket to take advantage of the dip? That is where traditional retirement advice fails, and it fails hard for single filers. Then there's the fact that longevity risk is amplified. Longevity risk exists for everyone, but for single retirees, it's concentrated. There's no spousal income continuing if you pass early, but more importantly, there's no secondary income if you live very long. You must design a portfolio and withdrawal strategy that lasts through potentially 30 plus years, absorbs inflation alone, funds rising healthcare costs, and covers long-term care without shared caregiving. Many retirement models use average life expectancy. Singles often need to plan closer to the high percentile longevity because there's no shared risk pool. That shifts withdrawal assumptions. It also shifts how single filers invest their assets. If you have a pension on top of Social Security, longevity risk is greatly reduced. But what if you don't? That is where you need to really plan where your income comes from. Having a few years of cash flow in bonds is a great starting point, but if you still project to cut it close with running out of money, this is where decisions must be made. You do have a few options in this instance though. The first is cutting expenses, and that's not always easy to do if you're single. Often your expenses are necessary and not luxury, but first start there to see if there's anything you can save on monthly. Then you want to look at some alternative investments. This is one of the very few places I find that annuities work well. They guarantee an income stream that lasts for your life and act as a pseudo pension. Often that income stream for single filers over 65 is upwards of 6%, meaning that they are guaranteed something for life that is higher than what they could have otherwise pulled from their accounts if they just were invested normally. Of course, this is going to limit their liquidity, but through a combination of cutting some expenses and guaranteeing a higher source of income, this can be enough buffer to mitigate longevity risk. But use annuities only if you have to. So why must single filer withdrawal strategy be different? Most common advice suggests the standard sequence. Spend your taxable accounts first, then your traditional IRAs, and save your Roths for last. That framework may work well for many retired couples. But for single filers, compressed brackets and lower IRMAA thresholds often require more nuanced sequencing. Single retirees may need to use Roth accounts earlier to prevent bracket spikes, smooth income more tightly year to year, limit capital gains recognition, and avoid triggering Medicare surcharges prematurely. The margin for error is thinner. One large withdrawal in a single year can push a single filer into higher brackets more quickly than a married couple. That means dynamic withdrawal modeling matters more. Again, rules of thumb fail you here. They are a starting point, but true withdrawal strategy is planned for early in the year and optimized throughout. Then there's the fact that long-term care risk is concentrated. Most retirement advice discusses long-term care as a possibility. For single retirees, it's not just a possibility, it's a central risk variable. Married couples often provide informal care first. That delays or reduces paid care expenses. Singles typically don't have that luxury. If care is needed, it's fully outsourced, it's fully funded, and it's fully your responsibility. Most planning frameworks don't elevate the risk enough for singles. That can lead to underestimating required liquidity and reserve planning. I have seen single or widowed filers' total retirement plan derailed because of a long-term care event. They might have something like $1 million in IRA money, but the average long-term care event is around $120,000 annually and lasts for about 3 years. So to get the true after-tax withdrawal needed, to get the care they're talking about, they need about $140,000 to $150,000 annually. If markets continue to go up, then this is likely not a big problem. But if this happens during a down market, it magnifies their spend down rate. So let's assume an average rate of return for a retiree facing a long-term care event for 3 years is 6% in years 1 and 3. But in year 2, let's say they face something similar to what happened in 2022, where a 60-40 portfolio was down around 18%. After 1 year, they would have roughly $906,000 left, assuming they took the money needed out at the beginning of the year and then earned the 6%. Following that same strategy for year 2, they would have roughly $624,000 left, a nearly $300,000 decrease. And by the end of year 3, they would have roughly $535,000 left. That's half of what they started with, and that assumes the average event. So it's very important to do a few things early in retirement to plan for this. First, fill up low tax brackets when possible and convert to Roth to make the money last longer. Understand average cost of care in your area. Consider long-term care policies as a supplement to cover some of the expenses. In the example above, a policy that covers $60,000 a year of expenses would still leave the investor in this example with around $700,000, just a 30% drawdown on the assets versus the 50% they're facing without it. So why does generic advice feel off? Many single retirees tell me something similar. I followed the standard advice, but it didn't quite fit. That's because the framework wasn't built for them. Generic retirement advice optimizes for households, and frankly, it even gets that wrong. Single retirement planning optimizes for precision, income smoothing, tax bracket awareness, risk concentration, and longevity protection. Those are different design principles. Before we go over an example, I wanted to thank you for watching our video today. As I said earlier, we are prioritizing single filer strategies this month. So if you're a single filer, we will have 3 more videos in March dedicated just to you. To make sure you don't miss them, make sure you subscribe to our channel and throw us a like on this video. And if you need a little more hands-on guidance, please feel free to schedule a meeting with the NavWell team via the link in the description below. We would be more than happy to see if there's a long-term fit for any of you who want to work with us. Let's jump back into the video and go over that example. Consider 2 plans for retirees with $2.5 million. One's for a married couple and one's for a single filer. Both withdraw $120,000 annually, and everyone here is 65 years old. $2 million of the money is in pre-tax accounts and the other $500,000 is in a taxable account. The married couple has a total Social Security benefit of around $60,000 at full retirement age. And the single filer has benefits of $30,000 at full retirement age. The married couple may stay comfortably within joint brackets. Even after paying taxes on their distributions for living expenses, they likely still have room for another $100,000 or more of conversions in that 22% bracket after accounting for their standard deduction. They split income across 2 Social Security checks and don't have to be in a rush to collect if they don't want to. They share housing costs and likely avoid IRMAA thresholds. In fact, a good place to start would be to model in Roth conversions to see if there's an optimal number to convert to lower their traditional balance before RMDs and Social Security kick in. Their plan might look something like this. While they're 65 and 66, they'll pull income they need from their pre-tax accounts. By the time we factor in all of their deductions, including the standard deduction and the portion of their enhanced senior deduction that isn't phased out, they'll have roughly $41,000 worth of deductions in a year, which means they have Roth conversion capacity of roughly $132,000, meaning the IRA is reduced by about 20% annually and repositioned. Taxes are paid from the brokerage, and then let's say they want to take Social Security at full retirement age of 67. That gives them $60,000 of benefits that is 85% taxable. They take the other $60,000 from the IRA. The Roth conversion amount actually increases by about $9,000, which is basically just the amount of Social Security that's not taxed. And taxes are taken out of the brokerage account. They continue on that path until age 75. Assuming a 6% growth rate across all assets, everything will be positioned in Roth funds or spent out of the IRA by the time they're 76 years old. They'll have at that point roughly $2 million in Roth funds to live on in conjunction with their Social Security and their brokerage account, which is worth about $100,000. And assuming static tax brackets, they would have paid roughly $400,000 in lifetime taxes on the conversions. The single retiree, on the other hand, will hit higher marginal rates sooner because of higher taxes, trigger IRMAA more quickly and at higher levels, carry all fixed costs alone, and have less flexibility in downturns. The retirement and conversion strategy would look something like this. The optimal bracket for the single filer is likely somewhere in the 24% bracket. They will lose their enhanced senior deduction. Their tax bill is roughly $7,000 per year higher while converting, and roughly $280,000 higher overall during the course of their 25-year retirement. And this is what makes it harder. The more compressed tax brackets push the single payer into higher brackets and IRMAA surcharges sooner, and results in an increase of nearly 75% in lifetime taxes and surcharges paid. Same exact portfolio, but very different pressure points. Why do singles need a different framework? Single retirement planning should focus on early Social Security optimization, tax diversification before retirement, careful Roth timing, income smoothing strategies, long-term care stress testing, and conservative early withdrawal modeling. Not because singles are at a disadvantage, but because the structure is different. The absence of a second income layer changes the math, and more punitive tax brackets necessitate more strategy early on. The bottom line here is that most retirement advice doesn't fail because it's wrong. It fails because it assumes 2 incomes. If you're single, your brackets are tighter. Your risks are concentrated, your Social Security decision carries more weight, and your withdrawal strategy must be more precise. Retirement planning isn't one size fits all. If you're single and approaching retirement and you want a plan designed around your structure, not a married couple template, that's exactly what we do here at NavWealth Partners. Thank you so much for watching, and as always, make smart money decisions.